Smokers, this ain't no jokers. Welcome back to Strongman Personal Finance. PayPal Holdings Incorporated, ticker symbol PYPL, just reported Q2 2024 earnings, and the stock is up 8.25%, whereas VT is probably down because it has international stocks. Let's go ahead and cover the earnings, because apparently one of our favorite investors of all time, Jeremy LaFave, prefers to buy individual stocks like PayPal instead of a total world index fund, because buying PayPal will somehow beat an index over the next 30 years. So as we know, PayPal is a transaction processor. How do I know this? I use it. People send me money, PayPal deducts a fee, and that's how they make money, primarily. They also offer credit, and then they sell the credit to a third party, blah, 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 blah. But basically, they make their money off of transactions, people sending each other money over the internet. I wonder how many different possible ways there are to do that. I guess PayPal's it's got the moat, though. PayPal's old. That's the one thing they have going for it, which is apparently good. So we've got the Q2 2024 results here. Net revenues increased 8% to $7.9 billion. Okay, so they're increasing revenues. Transaction margin dollars increased 8%, so revenue grew 8%. Transaction margin, this is the profit from their transactions. Because remember, people send money, the recipient, the vendor, usually has to pays the fee, and the margin is basically the fee that PayPal receives from the vendor, net of any directly attributable costs to send the money that PayPal has to incur. So transaction margin dollars are, they're in line with revenues. They're growing faster to $3.6 billion. So it's still a very profitable business, at least from a transaction margin standpoint. GAAP operating income increased 17% to $1.3 billion. Okay. Non-GAAP operating income, which is completely worthless, increased 24% to $1.5 billion. GAAP operating margin expanded 126 basis points. So I like how they put the big number there, 126 basis points. That's 1.26%. So their profit margin before interest and taxes went up by 1.26%. Okay, that could just be a temporary fluctuation. We don't know. But, they're showing growth, at least for now. For earnings, not for accounts. GAAP EPS increased 17%. So we see, decent revenue growth. Margins are staying roughly where they were before. So we don't see a collapse in margins due to competition. Operating income is up a little bit. Operating margin is up. Overall, not a bad quarter, right? But that's not the problem. The problem is the future. What is going to happen to PayPal? Does this company have a bright future where they can continue to grow profits and return those profits to you as the shareholder? And is it worth the risk to invest in this company versus either buying a bond, which is much more guaranteed, like a treasury, or investing in a total world index? You have opportunity cost. Should I buy PayPal, a business that is currently growing revenues and profits? Will they continue to grow revenues and profits? And is the risk worth it versus buying something that, is a lot safer, like a treasury, or buying every stock in the world on market cap weights? We'll see. Total payment volume increased 11%. Payment transactions increased 8%. So there's more transactions going on, and the amount of dollars that are being transacted is actually growing faster than the amount of transactions. So basically what's happening with PayPal is all of their active users are using it more. That's it. But are they growing active users? We'll see. Adjusted free cash flow of $1.1 billion, which excludes the net timing impact between merchant and group buy now, blah, 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 blah. Okay, so profitable, growing revenues, growing profits. Looks amazing, right? Cash, debt, returned $1.5 billion to stockholders by repurchasing approximately 24 million shares of common stock. So they're buying back stock. I mean, everything just seems honky-dory, right? Let's look at this in a little bit more detail. So we already talked about revenue growth. The transaction margin, I'll show you on the income statement. I think it's down here. The transaction margin is calculated by taking the net revenues right here, subtracting transaction expense, transaction and credit losses, and then dividing that number by net revenues. That's how you get the transaction margin. It's these top three lines right here. Just so you know, I verified it, at least the first one. So revenues are up, margin dollars are, in line with revenues. Operating income is up 17%. Margin is up 1.26%, 126 basis points. Effective tax rate, whatever. Okay, so everything looks great. Let's go ahead and look at the balance sheet. So we got 62 million of current assets, the vast majority of which are funds receivable in customer accounts. This is basically money held in custody by PayPal. If you have money on PayPal, that's not their money, but they have to report it on their balance sheet. But they also have a corresponding liability, funds payable and amounts due to customers, because they're basically the custodian of your money, but that's not their money, but it's part of their balance sheet. So the real cash equivalents they have is 7.7 billion of cash, 5.9 billion of short-term investments, and 987 million of accounts receivable. This is really the liquid cash and current assets that they have, which is approximately 8 plus 6, so 14, roughly $15 billion of liquid assets. Their current liabilities that aren't related to customer accounts, very small amount of accounts payable and accrued expenses. So they have a pretty solid current ratio and a pretty solid quick ratio, which is a measure of liquidity, which means they're probably not going to go bankrupt. Okay, they're doing just fine. They have positive cash flow. They have plenty of cash and short-term investments. Let's see. Loans, interest receivable. Okay, they got some loans held for sale and then prepaid expenses. I'm trying to see if there's anything crazy on here. Looks like an increase in long-term investments. It could just be them piling money into, I don't know, longer-dated treasuries, perhaps. Property, plant, and equipment. They're not really buying any new PP&E, but it's a very PP&E, property, plant, and equipment-like business. I mean, they've only got 1.4 billion of net property, plant, and equipment. That's the cost net of accumulated depreciation. No real red flags on the balance sheet. Long-term debt seems manageable. Treasury stock. So we can see treasury stock has increased negatively. It's grown negatively. Why is that? When a company buys back treasury stock, you're going to see a bigger number. That means they're buying back shares. So if you look at the difference, how much did they buy back? According to this, they bought back they spent almost $3 billion buying back treasury stock over the last 6 months. That's a lot. Additional paid-in capital, when that increases, they've issued shares, but that's probably because of stock-based compensation. So companies, they'll give stock-based comp to their employees. The employees will exercise the stock options. The cash will go to PayPal. PayPal will generate shares, and then they'll take some cash and they'll buy back shares to make sure they're not growing. So, okay, but we know the shares outstanding are dropping. So the net is that shares are dropping. So you as the owner of PayPal own more and more of the company. Retained earnings is up. That means they recorded a profit. Let's see if they cut any major expenses here. So we see revenues are increasing. So transaction expense is going to go up. Transaction and credit losses actually went down, even though they grew revenues. They cut customer support. They cut sales and marketing. They cut tech and development. They increased general and admin, maybe it's stock-based compensation, and they have some restructuring costs. But overall, their operating income cut, but grew decently. The question is this going to continue to grow in the future? We'll see. Okay, EPS is up. The amount of shares outstanding is down. We got the statement of cash flows here. So they have positive operating cash flow. Let's see. The main difference is, looks like the originations of loans receivable and proceeds from repayments and sales of loans receivable. This is cash coming in from customers. The net was a lot less. They had a slight inflow from loans receivable in the current quarter versus an outflow in the prior quarter. That seems to be the big difference between the two quarters. That's why they had negative $200 million of operating cash flow in the second quarter of last year. Is because of the difference of, it's like a timing difference of loans receivable. So basically they received a bunch of cash payments for loans receivable in the second quarter of 2024 versus the prior year. That's why there's a difference there. But overall, I mean, you're not going to see that much change in operating cash flow. They're not massively growing it. It's just a timing difference. They're not really buying a lot of property, plant, and equipment. Let's see. Purchases of investments. And it's the same thing here. It looks like there's a net outflow of cash for loans receivable longer term. And they spent about $9 billion buying investments, and then they had some maturities of investments. That's probably bonds or something like that. Nothing real crazy there that I see. And if we go to cash flows from financing activities, this is where you see stock buybacks, stock issuance, debt repayments. Purchases of treasury stock. So they spent $1.5 billion in 3 months buying back treasury stock. There's a little bit of issuance of shares. It's probably from stock options. Borrowing under financing. Looks like they had some temporary borrowing. So overall, I mean, the finances seem fine. Like, if you look at it on the surface, that's fantastic. Now, the big problem is, of course, account growth. So we know revenue and everything's growing. But how much can you grow revenue if accounts don't change, if active accounts stay flat or start to decline? If you look at June 30th, 2023, they had 431 million active accounts. June 30th, 2024, they have 429 million. So they dropped active accounts by about 3 million year over year. Interesting. So it says 0%. It's probably like a rounding error, but active accounts are actually declining. They basically peaked in active accounts. And there's only so much profit you can squeeze. There's only so many expenses you can cut. There's only so many fees you can collect. That's a problem. Okay, this is a future problem. It's all about the future. What is my opportunity cost? Should I buy PayPal with flat accounts that can maybe grow their profits for a little bit longer? Or should I buy something better, a better alternative? So everything looks good except active accounts, okay? And that's actually a big one because we're talking about future cash flows. And of course, last but not least, there's 100,000 different ways to send money. Google Pay, we got PayPal, Venmo, okay, Zelle. That's a big alternative because Zelle doesn't charge transaction fees. At least that's been my experience. Cash App, Apple Pay. Oh, I could write somebody a check. There's 100,000 different ways to freaking pay people. I think PayPal's peaked, at least from an account standpoint. Maybe they can grow their profits a little bit more. Maybe they could squeeze more money for a while out of their active accounts. But in the long run, flat active accounts, not drawing people in, is a problem. Let me know your comments below. If you like my analysis, you can send me $50 and I'll do a stock video for you. I will not do stock price predictions. If you want to buy my book, Stop Being a Broke Loser, it's on Amazon. Check it out. And if you want a one-on-one tutoring session with me or you just want to talk to me, $75 an hour. See the pinned comment below? Talk to you later. Cheers.